Alright, welcome back to my YouTube channel, Study with Clef. My name remains KM, and today we're talking about another important standard, especially for corporate reporting, which is now strategic business reporting. So IFRS 2, which is share-based payments. IFRS 2 will have an outline of what we'll also look at today, which is the definition, the types of share-based payments, the measurement and recognition, then disclosure requirements. IFRS 2 is not really a big standard like that, but it relates to IAS 19, which is still another type of payment. Now IAS 19 is employees benefit. So we'll look at the definition, types, the measurement and disclosure requirements. I have an important illustration from the recently concluded ICAN corporate reporting May 2025 question 6, which is question at the professional level. So IFRS 2 share-based payments said, starting with the definition now. Share-based payment is a transaction whereby an entity buys or purchases goods and services or enjoys services of an employee or employees in exchange for payment through either cash or through shares. So once again, the definition of IFRS 2 share-based payment is a transaction where an entity purchases goods and also enjoys services of employees in exchange for payment through shares and or through cash. So it deals with transaction of purchase of goods for payment through shares through cash. So IFRS 2 share-based payments says a transaction that occurs whereby an entity purchases goods or enjoys services from its employees and pays them back through shares or through cash. So when an entity, like a company for example, has so many staffs, then instead of you to pay salaries and wages like the normal thing, now you are paying your employees in shares. You make them part of the shareholders. We'll talk about when you start doing published accounts, you do so many things that relate to shares. So in case you are just joining accounting and like you may not really know what shares is, I believe that you understand what shares are. So instead of paying back through salaries and wages, which is like the most, you pay your employees through shares, or you purchase goods and services. Now, instead of paying the customer or the supplier, instead of paying the supplier cash settlements, now you are paying back through shares, or in some cases you return them back through cash, which is the normal way. So that's the definition of IFRS 2 as defined by IFRS 2 share-based payment. So transaction of the purchase of goods and services employed or enjoyed by an entity in exchange for payments through shares or through cash. So we move to the types of share-based payments. So for the types of share-based payments, we have one, equity settled, 2, cash settled, and 3 is the option to settle either through cash or equity. So the types of share-based payments, the first of them is equity settled. So just like you said, you purchase goods and services. Instead of paying your suppliers cash in exchange for the goods which you have purchased, and you are paying them back through shares. So equity settle is a payment of payment for goods and services in exchange with shares, while cash settle is still the normal cash settlement. So cash settlement you are paying back with cash. So these are the three types. Then the last one, which is option to settle either through cash or through equity. So you have the leverage to pick between the two. So that these are the types of the share-based payments that we have. Then moving to the measurement and recognition criteria for IFRS 2 share-based payments. So for example, you purchased goods. Let's say for example you purchased goods worth 80,000. So instead of paying this back through cash, you are settling it with shares. So under equity settlement, you record this transaction using the debit expenses, which is to be debited to profit or loss. Then you credit equity, $80,000. So instead of you to pay through cash, you are paying with shares, which is equity now. So you purchase goods worth 80,000. Instead of you paying that 80,000 with cash, you are paying through equity. So since both of these things are related to payment, expenses must be recognized in both cases. We've done expenses when we started this class initially. So then you are paying through equity, through shares. So that's how we are crediting shares. By crediting equity means we are adding to equity. Equity is a credit item. So crediting it means we are adding to it. Expenses is a debit item. Debiting it means we are adding to it also. So that's for that. Then if this transaction on cash settlement, we said in both cases expenses will be debited, saying it is still payments, just like the name implies, share-based payments. So expenses, profit or loss. I'm still using the same example, 80,000, then we'll credit liability, which is like a provision. Liability, 80,000. So we will make provision for the payment of the goods, which is a liability now. That's for cash settlement. So this is for equity settlement, while this is for cash settlement. So let me demarcate it. This is equity. And this is for cash settlement. So this is an illustration to show this equity settlement and cash settlement of share-based payment. So now to the measurement and recognition of share-based payment. How do we recognize share-based payment, or how do we measure share-based payment? So we measure share-based payment based on some terms, which includes the measurement. So the measurement and recognition, we say share-based payment is recognized and measured based on some terms, which includes the grant date, the vesting date, and then the exercise date. So grant date, vesting date, the exercise date. Grant date is the date which the transaction occurred, meaning that the date which the agreement is made, that instead of us to pay you through cash, we'll be paying you through shares. For example, we purchase goods from a particular supplier, and then we say instead of us to return back cash to you as an exchange for what you have purchased, we will be returning or we'll be paying you back through shares. So you become part of our shareholders for some certain time or thereabout. So that's like the grant date. That date which an agreement occurs to actually consider share-based payment is known as the grant date. Now the vesting date is the date which conditions are being met. So vesting date relates to something called vesting condition. Vesting conditions are those criteria or those things that must be taken into consideration before you can be entitled to this share-based payment. For example, we said employees which we enjoy their services, we want to pay them back through shares. So in exchange for their services, instead of paying them salaries and wages, we want to pay them back through shares. So we now said the vesting condition, one of them, for example, is just that they must be in the company till a particular period of time. Meaning that if you are not still in this company, if you have actually left as at this particular period of time, then you will not be entitled to this share-based payment. So one of the conditions is that they must still be available in the company as at a particular period of time, as at the reporting period, or as at the date which will be giving out this share-based payment. So that's one of the vesting conditions. So which relates to vesting date. Vesting date is the date which states that vesting conditions have been met. Then exercise date is the date which the employees receives the share-based payment. So the date which they receive the share-based payment is the exercise date. The date which they are entitled to this share-based payment is vesting date, while the date of the agreement of the share-based payment is called the grant date. So these are measurements of share-based payment. So we measure share-based payment based on this. If there's an agreement, then if the vesting conditions have been met, then that date which the vesting conditions were met, then the date at which they were paid this share-based payment, then we measure or we recognize share-based payment in these 3 years. So that's for that. So another important thing to take note is the values at which we use for each of these settlements. For equity settlement, you use the fair value. We've done fair value, which is IFRS 13. The fair value at a grant date. We'll take series of examples on equity settlement and also on cash settlement so that we understand this very well. So we use the fair value at the grant date to measure share-based payments under equity settlement. So fair value at the grant date, and it does not change. So regardless of the number of years that is going to be, it will not change. It will remain the fair value at the grant date. Note that for equity settlement, we use the fair value at the grant date to measure share-based payment, and it does not change for the reporting period regardless of the number of years. While for cash settlement, on the other hand, cash settlement, we use the fair value at each reporting period. So we're using the fair value at each accounting year end. Reporting period is the accounting year end. So we're using the fair value at each accounting period. So accounting year end, which means that this will change from period to period. For example, the fair value of our shares last year may be 20 naira per share. Now this year it may have increased or it may have decreased regardless. So we use the fair value at each reporting period, meaning that we're using the fair value as at December 30th, 2018 to value our shares for under cash settlement for that same period. So we're using the fair value of our shares at each reporting period. While for equity settlement, we use the fair value of shares at the grant date and it does not change. So this is fair value of shares. This is fair value of shares at each reporting period. So that's for that. Then for the disclosure requirements now. So disclosure requirements are those things that entities must state in their statement of financial position or in their notes to the account, just for users' understanding. So at first, you must disclose the type of share-based payment. So in all cases, you must disclose the type of your share-based payment. You must also disclose investing conditions. Like I said, vesting conditions are those things that you want, let's say you want to ensure that must be put in place before they can be entitled to that particular payment. So for example, one of the vesting conditions for employees is that they must remain in the company as at the reporting period. So at a particular date, they must be in the company or they must still exist in the company before they can be entitled to that share-based payment. That's something relating to vesting condition. So the vesting condition must be stated. So if any of them is not met, then they will not be entitled to the share-based payment. So that's that. You must also state the total expenses. That's another. You must disclose the total expenses. Then you must also state the fair value at the grant date for equity settlement, and also the fair value at each reporting period. That's another one. So you must disclose the fair value at the grant date and also the fair value at each reporting period. So the fair value at the grant date relates to equity settlement. Then the fair value at each reporting period relates to cash settlement. So it depends on the type of share-based payment which the company is using. That will state which of these two should be disclosed in the statement of in their notes to the account. This is disclosure. Then also you must state the total liability. Arising from this share-based payment. So you must disclose the total liability arising from this share-based payment. You must disclose the total expenses arising from this share-based payment. You must disclose the type of share-based payment. You must disclose the vesting condition. You must disclose the fair value at grant date and the fair value at each reporting period. Whichever one you are using. So that relates to the type of share-based payment which the company is using. So this explains all basically about IFRS 2 share-based payment, and then we'll take important or reasonable question. So we will take an example on equity settlement and also another example on cash settlement. So we have the first example. It says on 1st January 2014, Pi Limited grants 200 share options to each of its 500 employees. Each grant is conditional upon the employee working for the entity until 31st December 2017. The fair value of each share's option is 30 naira. Now, during 2014, 50 employees left, and the company estimates that 30% of the employees will leave during the 4-year period. During 2015, further 70 employees left, and the company estimates that 35% of the employees will leave during 4 years period. Now, during 2016, further 20 employees left, and the company estimates that 40% of the employees will leave during 4 years period. Then during 2017, a further 20 employees left. So, required, calculate the amounts to recognize an income statement for each of the 4 years ended 31st December 2017, and the amount that will appear in the statement of financial position as at 31st December for each of the 4 years. So that's that. So this question is on equity settlement. So that's that. So they said on 1st January 2014, Pi Limited, so this is Pi Limited. So we are told to calculate the amounts to be recognized in the income statement. That's expenses. Just like we said that share-based payment relates to expenses or equities or liabilities. It does not revolve around or more than those payments. That's that. So on 1st January 2014, Pi Limited grants 200 shares. Remember, 200 share options to each of its 500 employees. Each grant is conditional upon the employees working for the entity until 31st December 2017. Just like I said, vesting condition. So that's the vesting condition, that each employee must still be working for the entity until 31st December 2017. So which or any of the employees that is not in the entity or working in the entity as of this period should not be entitled to this share-based payment as of that particular date. That's that. He said the fair value of each share option is 30 naira. So the fair value of each share option, they gave us the fair value of the shares at the beginning. So that's equity settlement. So if we check the question, we will not see the fair value at each reporting period. So it means that this question is relating to equity settlement. If they gave us the fair value of the shares at each reporting period, meaning that 2014, 2015, 2016, and 2017, then we can say it is based on cash settlement. So this is based on equity settlement. So they said 2014 now. So we need to vest this particular entity to see the number of people that will be around or that will still be existing. So we have 2014. 2015, 2016, and 2017. So during 2014, 50 employees left. So in 2014, 50 employees left. And it says that, and the company estimates that 30% of the employees will leave during the 4-year period. So in 2014, there is an estimate that 30% of the whole employees will leave in 2014. So the total employees that will leave in 2014, total employees in 2014 will be 30%. Multiplied by the total employees. So in 2014, total employees that will leave in 2014. So it's 30% multiplied by 500 employees. So this will give us the number of employees that will leave in 2014. So 30% to 0.3 times 500. Give us 150 employees. So 150 employees will leave in 2014. So if 150 employees will leave in 2014 as a total, and they said 50 are left, then it means that there are still some that are about to leave, which we were not told. So that is what we are trying to find out now. So about to leave employees or estimated to leave. That will be 100. So 50 have left. It means that a further 100 will also leave. So making it a total of 150 employees to leave the entity in 2014. So continuing with the question, it says during 2015, further 70 employees left. Further, so 50 have left before, another 70 left, making a cumulative of 50 plus 70, making it 120. So 120 employees will leave in total in 2015. So they told us that 50 have already left. Now a further 70 will leave, adding to the previous one. So that's a total of 120 employees which have left in 2015. So the question also says that, and the company estimates that 35% of the employees will leave. So in 2015, 35% will leave. 35% of 500 also give us this 5 times 500. So 175 employees will leave in 2015. So they told us that 120 have left in total for 2015. So they told us that the total amount that will leave is 175. So about to leave now will be 175 minus 120, which will give us 55. So 55 employees are about to leave the entity, even though they did not state that they left, but we were able to figure it out that they will still leave. So continue with the question. It says that during 2016, further 20 employees left, and the company estimates that 40% of the employees will leave during the 4-year period. So in 2016, said estimate that 40% will leave. 40 times 40% of 500. They give us the total that will leave in 2016. Then they said a further 20. So it is previously 120. Now a further 20, making it a total of 140. That's 120 plus 20. That's 140. So if a total of 40% of the total employees will leave in 2016, so we'll have the total here, which is 40% of 500. 7.4 which is 200 employees. 200 employees is the total estimate that will leave in 2016. So we were told that 140 left in 2016. So some are about to leave, which is the difference between the two. That's 60. So 60 are about to leave, even though we were not leaving. Then in 2017, a further 20 left. So in 2017, a further 20 left. Adding to this is 140, making it 160. So 160. So none is about to leave. So it means that the total estimate that left in 2017 is 160. That's correct. So the vesting conditions now rests on those that will still be remaining. So if a total of 150 left the company in 2014, it means that this 150 will not be entitled to share this payment in 2014. If a total of 175 people left out of 500 in 2015, this 175 will not be entitled to share this payment in 2015. Then 200 left in 2016, this 200 will not be entitled, then 160 will not be entitled in 2016. So because of the vesting condition, they must still be working in the company as at the particular that's the accounting there. So calculating the total amount of expenses now, the share-based payment itself. So in 2014, share-based payments. In 2014, 150 are left. So out of the total of 500 minus 150, that will give us the total number that will still be existing in the company as at this particular period. So right? Multiply by, they said they gave each of them 200 share options. 200 share options. Then we said that share, this is not value, this is number of shares. So these shares now, since it is equity settled, we should use the fair value of the shares at the grant date. So multiply by 30 naira. Then 2014 is just a year out of 4 years. So they will not be entitled to the whole amount in 2014. They will only be entitled to a quarter of the amount in 2014, because 2014 is just 1/4 of the whole period. So this multiplied by 1 out of 4 years. So this will give us the total amount of expenses in 2014, which is 500 minus 150 gives us 350. Multiplied by 200. Multiplied by 30, multiplied by 0.25, which is 1/4. So we have, so let me suspend without 525,000. So 525,000 will be the amount of share-based payments, which is the expenses for 2014. So for 2015, we said 175 people left out of 500. 175 multiplied by 200 multiplied by, we said this grant value, this is the fair value of the shares at the grant date. It does not change, so it is still 30. Now, this is the second year out of 4 years, so this is multiplied by 2 divided by 4. So we have 500. 5 gives us 325 times 200 times 30 times 2/4. So this gives us 975,000. So for 2016, say 200 people will leave out of 500 minus 200. That gives us 300. So 300 people are those that will be entitled to the share-based payment in 2016. Multiplied by 200 shares for each of them. Multiplied by 30 naira per share. Then multiplied by 3/4. So this is 300 times 200 times 30 times 3/4. So this gives us 1,350,000. I have suspended my thousands up here. Then for 2017, which is the last day, said 160 will leave. So 500 minus 160 multiplied by 200 times 30 times, this is 4/4 now. Complete. That's the whole value. 500 minus 160, that's 340, multiplied by 200, multiplied by 30, multiplied by 1. 4 divided by 4 is 1. This gives us 2,040,000. So 2,040,000. So in the statement of profit or loss, which is the expenses, so according to the requirement now, the amount we recognize in the income statement, which is profit or loss. So this is like the extract of statement of profit or loss. Yeah. And so we have 2014. 2015, 2016, and then 2017. So we have expenses. Don't forget that these things are expenses, which is under share-based payments. So in 2014 now, we have 525,000 in 2014. Don't forget that. Suspending this. $525. That'll be the expense for 2014. Now in 2015, the total amount is 975. That 975,000 is a cumulative amount of both 2014 and 2015. So the expense itself, just like you said, that extract statement of profit or loss shows only the figures for a particular year. It is not carry forward statement. So we have to show the expenses related to 2015 itself, 2015 alone, not a cumulative amount from 2014. So we will exclude this amount from that of the cumulative amount of 2015. So the total amount for 2015 shown as share-based payment here was 965,000, which will deduct this of 2014 from, that's minus 525,000. So the expenses for 2015 is 450,000. So I hope you understand that. The cumulative amount for 2015 is 975,000, but it includes the expenses of 2014. So we will deduct that of 2014 to reflect only expenses of 2015. That's 975,000 minus 525,000. That gives us 450,000. Then for 2016, we have a total of 1,350,000, but it includes that of 2015. 2015 has 975,000, which will be deducted from. So so here, let me just put it so that we'll be able to relate to it. 975 minus 525. That's what gives us 450. So in 2016, we have 1350 minus 975. 975, which is for 2015. That will give us the expenses for 2016. So 1350 minus 975. So we have 375 in 2016. And in 2017, we have a total of 2040 minus 1350, which is for 2016. So it's a cumulative figure. And the expenses statement of profit or loss shows only the income and expenses for a particular year. So it should not show the cumulative amount from each year, carrying it forward to another year. It should only show expenses for each year and not the cumulative amount. So 2,040,000 is a cumulative figure of all of the years which are deducted. So 2,040,000 minus that of 2016 that includes the result. That's how we get the share-based payment expense for 2017. 2040 minus 1,350. So what they are paying is 690. So what the company is paying as share-based payment in 2014 is 525,000. What the company is paying as share-based payment in 2015 is 450,000. What the company is paying in 2016 is 325,000. And what the company is paying as share-based payment in 2017 is 680,000. Based on their vesting conditions. So that's one. Then the other one is the extract of statement of financial position. So for statement of financial position, so we have the extract of statement of financial position. Since this is an equity settled share-based payment, so we will have it under equities. So, like we said, the statement of financial position is a carry forward balancing statement. So it includes both 20-year carrying it forward to each year over the years. So we'll have the total amount just like we have calculated there. So in 2014, in 2015, in 2016, and in 2017, have this suspended with our work. We have the equities now. We have 525,000. We have 975,000. We have 1,000. 1,350,000 and then 2,040,000, which is a cumulative figure that's equities now for share-based payments. So this is share-based payment. So that's that for the question on equity settlement. We'll also take another one on cash settlement. So the question now, ICAN May 2025, it's just is the recently concluded corporate reporting professional exam for ICAN students, and then we'll be treating it. So here, question 6 says, share-based payment occurs when an entity purchases goods or services from another party, such as a supplier or employee, and rather than pay directly in cash, the transactions are settled by issuing shares, share options, or future cash amounts linked to the values of the shares. Before the publication of IFRS 2 share-based payments, there appeared to be an anomaly to the extent that if a company pays its employees in cash, an expense is recognized in the statement of profit or loss. But if the payment is in share options, no expense is recognized. You can discuss briefly 3 types of share-based transaction recognized under IFRS 2. Just like we said, we have equity settlement, we have cash settlement, and we have the option to settle either by equity or by cash. Then the big part, Adimola PLC is a company established by a group of information technology, IT experts based in Lagos with offices in various computer villages across the 6 geopolitical zones of the country. The company has a special development program for its young employees, which involves sending them to Japan and on a regular basis to acquire knowledge in artificial intelligence, as well as Internet of Things. However, because of shortage of IT experts with specialization in AI in the country, the multinational companies operating in Nigeria frequently poaches the staffs of Adimola PLC after they had been trained by the company. The board of directors of Adimola PLC decided to introduce a staff incentive scheme to prevent losing employees to the multinational companies. In view of this, Adimola PLC granted 100 share options appreciation rights to each of its 500 employees. Each grant is conditional under the employee working for Adimola PLC over the next 3 years. Further information available about the share appreciation rights are as follows. We have years December 31st, 2019, December 31st, 2020, and December 31st, 2021. Actual employees leaving the company in the year, we have 35, 40, and 22. Estimates of further employees that may leave in the future, 60, 25, and nothing. Number of employees whose interest is expected to vest and actually vested, 405, 400, and 403. So Adimola PLC estimates that fair value of share appreciation price at the end of each year in which liability exists is as shown below. December 31st, 2019, the fair value is 15 naira. December 31st, 2020, 18 naira, and December 31st, 2021, 20 naira. Now we can calculate the expense and liability that will be shown in the financial statement of Adimola PLC for all the relevant years. So just like we did. So this is on cash settlement. You can see that we have the fair value of these shares at each reporting year end. So that's Adimola PLC. This is very straightforward. Although it will be looking very hard like the example, seeing this kind of lengthy question. You will carry the weight to even think that we may not be able to do, but it's very simple. Then we have already been given the total number of employees, so we've done the vesting conditions for it, given us the total number of employees that will be in the company as at the year end. So the number of employees whose interest is expected to vest and actually vested. So those whose interest are expected to vest and actually vested. Those are the people that will be entitled to this share-based payment. So this is, remember, it's a cash settlement. because we have fair value at each accounting year end. And then we said when we are doing cash settlement, it affects two entries. We debit the expenses and we credit liabilities, don't forget. Then it is equity settled, we debit the expense and credit the equity. So that's for that. So for December 2019, they said 405 number of employees actually vested. So 405, you don't need to do the computation again. So 405 multiplied by how many shares to each of these employees? Said 100 cash shares. 100 cash shares. So 405 out of 500. 405 employees out of 500. So multiply by 100 shares, then multiply by the fair value at December 2019, which is 15 naira. Now remember that December 2019 is just a year out of the total 3 years. So we have multiplied by 1 divided by 3. So we have 405 multiplied by 100 times 15 times 1 divided by 3. So we have 202,500. So 202,500. Then for December 2020, we have 400 shares, 400 employees actually vested. So those are the people that will be entitled to this share-based payment of 100 cash shares multiplied by the fair value as at December 31st, 2020 is 18 naira multiplied by 2 divided by 3. So we have 400 times 100 times 2 divided by 3 times 18. So we have 480,000. 480,000. Then in December 2021, they said 403 employees vested. It's like 100 shares times the fair value as at that date is 20 naira per share. Then multiply by 3/3. So we have 403. Times 100 times 20 times 3, which is 1. So we have 806,000. 806,000. So these are the expenses, are the liabilities rather. These are the liabilities of a share-based payment. So in the statement of profit or loss, which is the income statement, so for 2019, 2020, and 2021, we will have expense as an head. Don't forget, it's just an extract. We have share-based payments. let's suspend in thousands. So the first year we have 202,500, that's 202.5, so that's suspended in thousands. So these are expenses. We said expenses are not carried forward. They are not carried forward. So in 2020 now, we have a cumulative amount of 480,000, which includes this value. So 480 minus 202.5. So we have 277,500. That's the value in 2020. Now in 2021, we have a cumulative figure of 806,000. 806,000 minus 480,000, which is 326,000. So this is the value of the expenses for each of the year. Now, statement of financial position. So this is to extract it's the 1st December. So we have 2019, we have 2020, and we have 2021. Thousands. So we have liabilities, which is in year 1 we have 202,500. Year 2 we have 480,000. Remember, the statement of financial position are carry forward statements. Then in year 3 we have 806,000. So with all the big grammars in the question, this is just what is required. Show the extract of the statement of profit or loss and show the extract of the statement of financial position. So we have taken an example on the equity settlement and also on the cash settlement. So we define share-based payment as a transaction which arises from an entity purchasing goods and services or enjoying services of employees in exchange for shares as the consideration or cash as the case may be. So we also talked about the types of share-based payment, which is cash settlement, equity settlement, or the option to use either cash settlement or equity settlement. Then we talked about the disclosure requirements and the measurement. The measurement which relies on the grant date, the vesting date, and the exercise date. Then the disclosure requirement which say that the entity must state certain information in their notes to the account. One of them is the type of share-based payment that the company has entered into. Then the other one is to disclose the fair value of your shares at the grant date and also at each reporting period based on the type of share-based payment you are using. You are also to disclose the total expenses of the company as a result of share-based payment, and also to disclose the total liabilities or total equity arising from the share-based payment. So I believe you understand share-based payment IFRS 2 now, and then we can take several questions on our own. So thank you for staying by, and also we would like to see you more in the coming videos. So thank you very much. My name still remains Caleb, and this is Study with Caleb. Please like and share to as many as possible. I mean, there are people that may actually need to do this, most especially people that are preparing for ICAN examination or ACCA or any other professional accounting examination. So please share to as many as possible and subscribe. Thank you very much. God bless.